Welcome to Shadow of Truth, and today is Tuesday, September the 1st, 2015, and we have the distinct honor and pleasure of welcoming back Mr. Craig Hemke, the proprietor of TFMetalsReport.com. How you doing, Craig?
I'm fine, Roy. The honor and pleasure is all mine, my friend.
And it's always good to have the president, the mayor of Turdville on. It's because of the wisdom and insight that you bring to the table is top notch, my friend. And I'm very glad that you're here. So,
well, you're too kind, but thank you very much. Like I said, it's always fun to visit with you guys.
Geez, you two sound like you're having a love fest here.
Yeah, we are. It's a mutual adoration society day.
It's great.
Kumbaya time.
You'll notice we're not complimenting you in any way.
Nor do I expect it. I'm not part of your love fest.
Well, I wanted to start, Craig, with a death candle for the S&P 500. This is an article that you just released about an hour ago, and there is a very interesting chart that you have on there that goes back 25 years, and it shows these three very distinct downtrends, and it shows the 6 to 8 month period, more importantly, where everything is kind of topping. And that's where we're at right now. And there's the death candle has reared its ugly head. And the question that I have is, with the PPT doing their dirty work,
yep,
and invoking Rule 48 on a couple of different occasions recently, why would they not do that at this point? Why wouldn't they just get in there and work their magic and make it stop?
No doubt about it, Roy. And if you look at a historical chart of anything at this point, and you say, how could it be different this time? That is what is different this time, is that the Fed and the Bank of Japan, the Swiss National Bank, the ECB, they're all in there attempting to influence markets in the direction they want them to go, really on a daily basis. And so, yeah, it's easy to look at any historical chart at this point and go, just throw that stuff out the window. And that may very well be the case this time. But just in case it isn't the case this time, that's why I wrote that post this morning. And please feel free to link it into this interview or show that chart to everybody maybe as we're talking. I started following that monthly chart earlier this summer. I just kind of stumbled across it and went, oh, okay. Because I was already noticing that the S&P had topped out. There seemed to be real stout resistance or reluctance to get it above 2,100 on the daily chart. If you pull up a daily chart of the last 6-8 months, you'll see it. And I thought, well, this looks like it's stalling. And I think that's when I pulled up a 25-year chart and went, oh, okay. Well, what we need to look for then as our signal, as our sell signal, as our warning shot, is a monthly breakdown. Okay, we're not talking daily. We're not, just looking for a drop through a moving average or something short term. Talking about something far more significant. And when the market began to really break in August, I started following that chart on almost a daily basis, wondering if we would in fact put this, what I call a death candle on, which is just a big, long, nasty, ugly red candle on what we call a candlestick chart. And so on that chart that we posted this morning, and hopefully you can see here with this link, you can see that in the past two, turnings from a bull market to a bear market, they were both marked by one of these big, ugly, nasty red death candles on the chart. The first one came in the year 2000 after the market had run, almost tripled from 500 to 1,500. And then the market fell back 50% over the next 30 months. We had another death candle at the end of early 2008, and of similar scope, similar percentage to the where the high had been, and then the market fell back this time over 50%, something like 56% by
almost 57.
Yeah, by March of 2009. So then that took about 14 months to pull that off.
Which is half the time, which I want to make sure you know.
Yeah, exactly.
It was 30 months, and then it went to 14 months. That's a big deal.
That's a good point, Rory. And now here we are again. A similar death candle for the month of August has been painted. The dimensions of it are almost exactly the same, or very, very close to those previous death candles in 2000 and in 2008. And here it is again. And if it plays out again, and we're looking at a 50 or 55% drop from the peak, which was up north of 2,100, then we're talking somewhere between 1,000 and 1,100 on the S&P. And that would just, again, I put out warnings like this. I mean, not to scare people, or, drive people to my side or anything like that. It's just a warning. I mean, and if you're sitting there, if your friends and family, your coworkers are all just kind of blissfully unaware watching CNBC and, they make it sound like all the market ever does is go up.
Right.
And it's gone up now for 6.5 years, on all this cheap money inspired rally and driven and inspired higher by the manipulation of the central banks. But again, it doesn't, market history tells us that regardless of their intentions to drive it higher, the overall market can still overwhelm these central banks. Last Monday and the big crash is an example of that. And so we've got to be respectful of this. And I just hope people look at that, forward it to their family, maybe over Labor Day or at a barbecue, just have that chart in your back pocket, and if your brother-in-law is standing there talking about how great his 401k is doing, you might pull it out and go, now might be the time to move some of that to cash.
Yep.
And maybe save the guy a few bucks. And then come Christmas or next year, your brother-in-law might think you're smart. Might sit there and say, damn, thanks for that. Was great. Thanks for the help.
May give you something other than a lump of coal.
Yeah, exactly. It's just a really, like I said, maybe the Fed, they're so actively intervening now, all these central banks, that maybe they can somehow forestall this time. But boy, if anything should give just the regular layman reason to be cautious and to be of concern, that death candle is it. And if you've made some money, been fortunate to have your 401k recover from where it was in 2009, and you've ridden this wave, this easy money induced wave, now would be the time to take some profits and move to the sidelines.
Exactly, and that's exactly what I was just explaining to my wife. Please consider it. I mean,
yeah.
she's hardcore into it. I got out of it years ago. I have no vested interest in it whatsoever, except for the manipulation aspect of it, because it is completely 100% manipulated. And that's the only reason that I look at it, because it's always rainbows and unicorns as far as the eye can see, and that's just not reality.
And even without getting into all of the stuff that you and I and Dave know about the markets and where this is headed, just the average guy, your next door neighbor that has a 401k, working his desk job or traveling salesman job or doctor or whatever. That guy probably likely senses that something's amiss anyway.
Yes.
I saw a poll last night on the news that 71% of Americans are dissatisfied with the direction the country's headed. So there's just kind of general angst out there anyway. You pull out that chart and just say, well, here's something you might want to think about. I dropped that baby on my father-in-law yesterday, who I see every once in a while. He doesn't live where I live. And I was going to take him back on my way to taking him back to the airport. I said, hey, I know you got a lot of money in the stock market. You might want to take a look at this, and I think on balance, he looks at me like most fathers-in-law look at their sons-in-law, right? But even he paused for a few minutes and studied that chart and was, I could see him kind of rolling it around his head, wondering what that might possibly mean. And so, again, I just encourage everybody to pay close attention to what's going on there and not get caught flat-footed and see your accumulated dollar-based net worth get cut in half over the next few years and wonder, how did this happen? How come nobody told me? Well, you've been told.
You've been warned.
Yeah.
Prepare accordingly.
That's exactly right.
And
so Craig, don't lump me in with you and Rory. I don't know that much about all this stuff. I'm like Wall Street. I just make it up as I go along. But I just wanted to circle back to a statement you made related to this chart, which was you might want to take some chips off the table and take some profits and preserve them. Richard Russell is out, and I guess in his newsletter out last night, he is telling his subscribers we're basically warning them that they should be completely out of the stock market. Why wouldn't you want to? I mean, listen, I'm with you. This market was overvalued when the S&P was at 650, or it actually bottomed, I think, at 666, believe it or not. But it was still overvalued at that point. So now we're, 2.5 times higher than we were when the Fed started pumping this market up with QE. So we're at least 2.5 times more overvalued than we were when the S&P bottomed in 2009. Why wouldn't you take everything out of this market? Which is what I would advise anyone who's willing to listen to do. I
would, I guess, two reasons, Dave. One, I just remember my old days as a stockbroker 20 plus years ago. If you sold out today, even if you just sold 100 shares of GE at 38, down $2 on a day. I have no idea what GE is. I'm just making an example. And you dumped it that day, and the next day it goes back up 50 cents. Your client's like, that's 50 cents I lost because you dummy, you told me to get out. And with the Fed pumping things back up, we saw it just last week. I mean, we're down 300 points here on Tuesday. We could easily be back up a couple hundred tomorrow. Easy. And so you're always going to get that measure of regret because things could easily just bounce back tomorrow. And the other thing is, this is a general trend down. It's not going to be straight down. And as Rory pointed out, the Fed is still, and all the central banks are still going to be there pumping things up, trying to stem the tide. And maybe they'll be successful in avoiding, the curse of the death candle this time. And so for those folks, again, this isn't you or I would imagine. I mean, we're talking to the general clergy, not the choir on this one, or not the clergy, the crowd in the pews, not the choir on this one. And so that I don't know. I just think you get more traction if you tell them to start easing their way out rather than to dump everything. But I'm with you, man. I would be completely out 100% if that's the case. And lastly, as I've been telling people at TF Metals Report, I'm not looking to buy puts today. I'm not looking to buy, some kind of 2016 $1,500 S&P put yet, because history on that chart shows that you get the death candle and then you might get 2 or 3 months of some kind of a dead cat bounce. As the market tries to kind of come back, we could move back up to 2000 or to 2040 or something like that over the next 60 days, something like that. And then the bottom drops out. The death candle, just in hindsight, just marks when the trend was broken. And so there's probably still some time. I guess that's the final point to your question, David. There's probably still some time to be completely out for folks.
With the PPT and the Fed, we know, and Rule 48, we know that those tools are there. And
sure.
And the potential for them to come in.
Yeah,
there's another aspect that I want to look at, and that's the flip side, and it may not have any influence whatsoever. But recently, China has made a huge move with unloading a bunch of their treasuries.
Mm-hmm.
They devalued their currency, the yuan, the renminbi, and what role would that play if this thing starts tumbling down and China says, well, we need to make a move at this point, and they do? Would that have any influence over it? I mean, would that be another market signal to the general audience instead of the choir? I mean, or what?
I would look at it this way, Rory. If the reports are accurate, and it certainly seems as though they are, over the last 2 to 3 weeks, China has liquidated almost 10% of their foreign currency reserves that are held in treasuries, like $100 billion. And because they did that in a general time of global stock market weakness and folks that were out there seeking, I guess they call it the safe haven trade of treasury bonds, which is a whole other story. But since there was demand for what they were selling, they were able to unload $100 billion of treasuries without really moving the needle on interest rates, right? There was $100 billion of demand out there at the same time. And so if that was actually planned by the Chinese, we've all said, well, the Chinese can never unload their their foreign currency in reserves and treasuries because they'll so disrupt the market, and they don't want to do that. They got to be pragmatic and all that stuff. Well, that may very well be the case. So if that is the situation, then maybe they have an interest in creating the conditions that drive that safe haven demand into which they can liquidate treasuries. And so if you look at it that way, and I don't know if that's the actual fact or not, but if you look at it that way, it would seem that China would have an interest in continuing to promote volatility in the global markets so that they can continue to dump as many treasuries as they want without moving the price down. You know what I mean?
Yeah, without dropping a bomb.
Yeah, well, because again, if they just unleash them in mass, then interest rates rise and the value of those bonds, what they can sell them for, falls.
Yep.
So if they can create global market conditions that allow them to dump those bonds without seeing the prices of them fall, heck, maybe they even see the prices of them rise because there's so much demand. Hey, that's beneficial to them.
Craig, I'm gonna have to throw a hand grenade into that theory.
No, go ahead.
I'm tossing it into the the U.S. is exceptional. Let's blame China for all our problems bucket, because that's what's going on here. First of all, if you take today, for instance, that theory doesn't hold water because the U.S. dollar index is actually down.
Mm-hmm.
And if there was demand for treasuries, there'd be demand for dollars to buy those treasuries. And whenever in the past, when there's been a flight to safety flow of funds, the dollar goes up, and because the dollar goes up, treasuries go up. It's a chicken and egg thing.
Yeah.
But ever since QE started, the primary bid for U.S. treasuries has been the central banks.
Yes.
I mean, there aren't investors who are gonna make a flight to safety bid on paper that's yielding close to zero, and it's just the short-term treasuries that they'd be doing that with. There's also a natural short squeeze in the market for short-term U.S. collateral, meaning U.S. treasuries.
Mm-hmm.
And so, I mean, there's a ready market out there for China and China did the trade. They did the swap. That's what that operation, what do they call it? Twist, where the Fed was selling short and buying long on the U.S. Treasury curve. And the reason they were doing that is because China held a gun to their head and said, "Hey, we want to get the duration of our Treasury holdings down." So China sold us their long paper and bought short paper. And there's been a natural short, you've read about it for the last 5 years. There's been a huge collateral shortage in the market. That collateral being, high quality sovereign paper and
right.
Primarily U.S. paper. So there's a natural bid in the market for the paper China's holding.
And you could very well be right, Dave.
And you're right.
I'm not going to argue with it.
If they wanted to unload, 1.3 trillion in treasuries all at once, yeah, the market's not there, but $100 billion in short-term paper. Let's just look at when the U.S. does their bi-monthly treasury auctions. They're auctioning off between 50 and 100 billion twice a month.
Yes,
and that paper gets swallowed hook, line, and sinker, regardless of what the market's doing. I mean,
it's good point.
2-3 times over subscribed those auctions, if you believe those numbers. So I don't think China would have a problem unloading 100 billion in short-term treasuries, in a week. I don't think they could do it successively for a month straight, but I certainly don't think that they said, "Hey, let's cause global stock market turmoil to create a flight to safety bid for our treasuries." I have a alternative theory that, of course, you'll never hear on the mainstream media, but I think part of what China's doing with their currency devaluation is you got all these big global players sitting at the poker table, and they all know they're sitting on top of historically large asset bubbles in their countries. I mean, you'd have to be a complete idiot or Janet Yellen to not see the bubble.
Exactly.
And so China, I think, was the first one to fold their cards and leave the table and start trying to let the air out of their bubbles, because it's always the prisoner's dilemma thing. If you fold first and give in to what's coming, you're going to suffer the least consequences. And on the flip side, the U.S. is sitting here blaming China for everything, and meanwhile continuing to try and reinflate the bubbles that it's already inflated. I mean, they won't let this market go down.
I don't, and Dave, to your larger point, I wouldn't even begin to disagree with you. That makes all the sense in the world. If anything, the coincident timing of it all helped create that market, because again, if they did in fact move $100 billion in treasuries, again, the needle hardly budged. In fact, I think rates are actually lower than they were 2 weeks ago. I mean, the 30-year this morning is about flat, but it's 293, 292, something like that. So having just that general condition, if they need to continue. And, and wasn't it, Dave, I mean, you're more of an expert in this than I am. When they devalued the yuan, it sparked almost kind of a run of dumping the yuan. And they needed to sell those, at least that's kind of the rationale that's put out there. They needed to sell those treasury reserves in order to prop the yuan back up. So maybe, again, like you said, this is all just indicative of them just kind of laying their cards on the table and taking whatever chips they have left and going home.
Well, that's what I think's going on. And I think if China really wanted us to know what they were doing and how they were going to implement this strategy, they'd actually come out and tell us.
Yeah, and they're not going to do that.
Instead of floating the same type of propaganda stories that the U.S. floats.
Yeah.
But yeah, Treasury yields, I look at the 10-year because that's kind of the trading benchmark. And it's in mid-June, the 10-year was at 250, and now it's down to 220.
Yeah.
So it's yields are going down, and if anything, it probably is reflecting the fact that we're headed towards a global depression, which is what oil's telling us, which is what lumber's telling us. All the commodities are telling us that. Copper.
All the commodities. You're absolutely right. And with that long end dropping, any height or raising of the short end by the Fed flattens the yield curve and actually runs a risk of eventually inverting it if they were to take the path that all these pundits, from Livornia to that goofball from JP Morgan that they always parade on to CNBC, all these guys think that the Fed's going to normalize their balance sheet, whatever that means, and raise rates to some historical level. And it's all nonsense. Everybody knows that. But even if they were to try, they'd be faced with that classical, I guess, kind of Keynesian conundrum that always seems to happen, that if you invert the yield curve or flatten it out, that then you crush all economic growth. And then you're right back to lowering interest rates and QE again. So it's definitely presents a continued dilemma for these goons at the Fed that think that they can spin and mope their way out of this situation. And that's finally coming to an end, and their hand is finally going to be forced here over the remaining couple of months of this year.
I still don't think they're going to raise rates. I think there's a carry trade and an arbitrage, just a massive arbitrage where banks have basically borrowed at 0% and invested all over the world, at 0 plus X%.
Yes.
And if the Fed raises rates, the banks are going to have to start dumping a lot of those assets to pay back the money that they've borrowed from the Fed.
Why would they have to pay it back?
Because they're going to lose. I mean, if the Fed raises the cost to fund those investments, they roll over every couple weeks or 30 days or whatever. So all of a sudden, if you're invested in something and your spread narrows on it, you're not going to hold it. It's dead money.
But why wouldn't the Fed just print more money for them, say, or just?
Well, then you're talking about QE4.
And to that end, too, the only argument that I think anybody can even begin to make regarding why the Fed, in this environment with all the fake statistics and the malaise and the lack of growth and the disinflation and everything else, the only argument you can make that the Fed is in fact going to raise rates at some point is the fact that the Fed is going to do whatever is best for their banks. They're owned by the banks. And if they think that the best thing for their member banks is to raise short-term rates, then everybody else be damned, they're going to do it. But what you're pointing out, Dave, is that the ones most hurt by that derivative exposure are their member banks, which in a sense kind of disqualifies that only possible argument that you could make as to why they might actually do it. So I'm with you. I have always thought it's all just a mope job, a management of perception job that, once they start a QE, but this last QE, don't worry about it. We're It's a limited thing. We're going to taper it, and then we're going to be moving toward it. And they've always said that. They always used to have that forward guidance that we expect rates to start rising by the middle of 2013, or we expect rates to start rising by the end of 2014. And they've just continued to play that game. And now finally, here in 2015, the world is calling their hand to some extent, to keep using that poker analogy. Because at this point, either they're going to raise rates and do all this damage that you were just talking about, or they're going to reveal themselves to being just, mope spinning liars, and
they have a ready-made excuse though. They'll just blame it on China. They'll come out at the end of the meeting and say, because of all this volatility created by China, and that may be why they're letting the stock market drop like this, to create enough fear so that it covers up the fact that they deferred raising interest rates once again. And they'll just say extraordinary movements in the markets connected to the devaluation of the Chinese yuan, blah, blah, blah. So we're going to watch it closely, but we're not going to raise rates just yet because we think it'll contribute to the global instability of the markets. Yep. There, I wrote their FOMC statement for them.
There you go. An extra week from next Thursday, they'll use probably exactly that. Additionally, too, we get the BLS BS of the non-farm payrolls on Friday too. It'd be pretty easy for them to ring up their bureaucrat bean counters and the number crunchers at the BLS and say, why don't you massage your birth-death model for August and move around a few establishment job numbers and that kind of stuff and give us a number about 40,000 below what the talking heads on CNBC are saying Friday morning. That ought to give us a good data point that we can carry into the end of the month too. So we'll see.
You're such a cynic, Craig.
Gosh, I'm just no fun at all. Imagine that.
These are just honest bureaucrats trying to do an honest job.
Yes.
Right. And speaking of honesty, let's talk about honest money for a minute. It'd be kind of a shame to not talk about gold and silver with Mr. Hemke and get his take on how gold and silver plays out with all of this that we've been discussing as a backdrop. How do you see gold and silver responding, and China with those yellow devils over there in China? I mean, are they going to make some more announcements about gold? Do you think? Because I think that they are. I think
they sure seem to be buying a lot of pet rocks these days.
Yes,
yeah, they are. I'm still laughing. I remember seeing a movie when I was a kid about the Korean War and that lake in Korea where there's a major battle and the yellow devils just kept coming over the hill. So now, anyway, that notwithstanding, let's get the bad news first. Our worst possible scenario for paper price and the people that get nervous about that stuff. I've been warning folks on the site that if this paper price fluctuation just drives you bananas, if on a daily basis or raids like that Sunday night raid back on July the 19th, if that kind of thing causes you to lose sleep, then there is no better time than right now than to have some type of hedge or put or something. I mean, call up your broker and buy a couple of puts on the worthless sham GLD, something, so that if the paper trading algo machines and the bullion banks run gold and silver down in connection to a general commodity disinflation trade, at least you'll make some paper profits. Your stack will still be as beautiful and shiny and as wonderful as it ever was, but you'll make some paper profits out of the deal and you won't be full of angst and, kicking the dog and yelling at your wife and all that other stuff. And so now is the time for that because, as you pointed out, Dave, the disinflation, deflation bias in the commodities, it's reflected in the dying stock market, it reflected in the rallying bond market. All of this is there. Copper broke down on the monthly chart back in July and gave a really terrifying sell signal that maybe it could go all the way back down to where it went in 2008, which is down at $1.40 from the current level of $2.30. Crude, everybody knows all about crude, though it tends to dangle below 40 as it did in 2008 and it did last month and find support. Man, if it ever put in a monthly close below 40, we'd be talking 30 in crude. Lumber, all the different other metals, palladium, platinum, they all look terrible. And so if that spills over into, by these algos, these paper trading algos that just see that commodity weakness and then they sell paper gold and paper silver at the same time, they're going to go down. Now, I don't know how far silver could go because there's already such tremendous demand, at least on the retail investment level. We're starting to see it at the wholesale level as well. That might preclude it dropping to 8, but God, you could probably see 12. And gold, though, again, there's folks out there saying, oh, it's going to go to 950, it's going to go to 750. Gold would have to go back to 700 to be where it was in 2008. And the present time is radically different from a physical demand standpoint than it was in 2008. There wasn't Chinese buying. There wasn't this level of India buying. There wasn't this level of just regular investor awareness of how defunct the current system is, and that people should have precious metal as an insurance policy, if you will. And so I really think that the physical situation and the physical awareness will preclude the ability of the paper price to fall to 2008 levels in both gold and silver. But that said, I mean, if they're going to run the commodities even lower, and again, the charts look terrible, there's going to be continued pressure on paper, gold, and silver. There's just no doubt about it. And that's why I say, I mean, if that's the kind of thing that's going to make your hair fall out, then protect yourself. Then now's the best time that there could be to, just protect yourself by buying some puts. On the bright side, 1140 or so held as a pretty stout floor under the gold market from June of 2013 when we hit 1180 all the way through last November when we bottomed out around 1130. 1140 is kind of a median line, maybe 1150. That held as support. What was support is always going to act as then resistance. And we saw it again last week, 1150, and even again 1140 was a pretty stout resistance area for this recovery from the 1080 lows in July. That's a level that you want to watch. If we can get through there and kind of begin to draw away, it's where we kind of crapped out earlier today. If we can get through there, draw away, make a move toward 1180, then you might think instead that regardless of what happens in commodities, gold may have bottomed and is now finally rolling higher. So it's an interesting time to be following the metals, no doubt about that. And again, the risk is still there to the downside because they are just paper derivative markets traded by machine. But nonetheless, in the end, it just continues to present an opportunity for everybody to add to their protection stack at these low prices.
With global demand for gold and silver just exploding all over the place. And China, as we all know, has announced that they are going to begin selling physical in competition with the LBMA and the COMEX.
Right.
They're going to do that between now and the end of the year.
Right.
I mean, what kind of an effect is that going to have? Or is it going to have an effect? I mean, I know that you had spoken with Andrew McGuire and Ned Naylor Leland about some projects that they were working on over there that kind of went by the wayside. But I mean, there's got to be some insight that you have to how that could possibly, potentially affect what's happening right now.
It is definitely a process, Rory. And it's almost cliche to talk about the Chinese and 10-year plans and 20-year plans and 50-year plans, but that's really, in fact, the case. And I think they probably recognized that this debt-based, dollar-based global reserve system wasn't going to go on forever. But they were kind of maybe caught flat-footed like all the rest of us in 2008 and didn't have an alternative ready. And so as the central banks have tried to prop up the existing system, which is just a dead man walking, the Chinese have used this intervening 7 years to kind of prepare an alternative system for when the debt-based system finally does collapse. They've got all these direct currency swaps now. They've got the BRICS Bank, the BRICS Development Bank, which has now been renamed I think what's the New Development Bank or whatever the actual name of it is now. They've got the Asia Infrastructure Bank. I mean, they've got all this different infrastructure that they're building. And one of the legs of that stool is ultimately control of the global gold trade in the 21st century. Since the late 19th century, it's been based in London all through the 20th century. and into present day. But China is clearly moving in the direction that they want to be the global trading center, global physical hub for gold in the 21st century, and they're putting all these kind of these pegs in place to anchor it as just that. Basing a daily fix in yuan is coming later this year, as you mentioned. We've already got the Shanghai Exchange, which is delivering gold. It's even been recognized by the COMEX. COMEX is setting up, or has set up, a gold, a kilobar based gold contract. And so it's all trending that way, but it's not something that overnight is, at least probably not likely overnight to be a sudden change, but it's heading that direction. And what you wonder is, will the Chinese set up a similar system of rehypothecation and 100-to-1 leverage and all that kind of stuff? Maybe eventually. Who knows? 50 years from now, maybe it'll trend that way. But to begin with, it'll probably be more apt to be a non-levered or minimally levered system that'll be based more on actual spot physical availability and prices. And that's going to help us find a more true and fair price for gold and silver than this false scam of the paper trading price that we have now.
Well, that would be different, wouldn't it?
Yeah, it would. And that's where we're headed. There are a number of projects that are seeking to capitalize on that. This, if you don't mind, I might spin off. I haven't talked to Tom Coughlin in a couple of months. He's the guy that's going to be the head of, or is the head of, this allocated bullion exchange. That's the one that Andy's so excited about. Last I heard from Tom is they were still beta testing, trying to make sure this thing's completely ready to go. They thought it was going to be ready in April or May, and did a little bit of PR, even did a little PR with me on my site, and then it wasn't ready to go for I don't know what reason, but they weren't. But the last I heard from Tom is it's still coming. It's not like it's been shelved like the Pan Asia Gold Exchange, or any of these other things from the last couple of years. And it's not related to China. It's an independent thing. But what they're trying to do is link all of the different physical centers around the world, whether it's Dubai or Turkey or China or whatever, and link all these different physical gold prices together to give people an accurate physical spot price that they can work with at any time of the day or night, rather than just simply the once or twice a day fix in London that's primarily driven off of changes in the electronic futures market. So they're going that's still coming. Tom just told me that they're not going to do any more PR, have any announcements, and give people the sense that they don't know what they're doing until it's finally ready to go.
That's a formidable task that they're attempting right there. Yeah,
they are, and I think that's the main reason why the pushback from when they thought they were going to be ready in April or May is that that's a lot of stuff they're trying to cobble together into one system, and it will help when it comes in. And again, just promote an alternative, not necessarily at the retail level for you and I, but for the producers, for the big mines or any kind of miner to sell their product, rather than having to deal with it's about deleveraging and defunding the power that the bullion banks have and have always had over the paper market. If we can work around them and give the producers an avenue to work directly with consumers and buyers, then we again draw power away from the bullion banks and their agents in London, and get that much closer to finding a fair price.
That sounds very positive, and I'm looking forward to that being rolled out. I mean, if it takes another year, then it takes another year. As long as we get there, that's all that matters.
Yeah, and that's, I think, what the goal is there. But I mean, that's just what I know. I don't have any financial connection to them. I don't have a business relationship or anything. I'm just excited about it. I just think it's an interesting project. And again, we'll see how it all plays out in the months ahead. The only thing I would point out on that is, Jim Sinclair was on with Greg Hunter last week.
Yep.
And was talking about $50,000 gold. And I think Andrew might have even said something, referenced that, and the thing he did with Eric King late last week. And that's all well and good. Some folks look at gold and, everybody wants to know what it's really worth, because we all know $1,100 an ounce, though there's still deliveries being made at that paper derived price, which gives it some legitimacy. There's no clear title. There's 100-to-1 leverage, if or not more. And everybody, when the music stops, there's going to be 100 people trying to sit on one chair to claim that 1 ounce. And so we don't know how much gold there actually is in the West. We know it's been shipped east. We know what China's demand is. We see the Shanghai demand. We hear all these stories about and the net export numbers out of the U.S. and out of the U.K. and how it goes into Switzerland and it gets recast to kilobars and it's exported out of Switzerland. Nobody knows. We don't know how much gold is in Fort Knox and of what quality it is. And so we don't know how much gold there actually is. And so without knowing how much gold there actually is in the dollar-based side of the scheme, it's impossible to say what a price target would be. Some folks look at it and say, well, we know what M1 is, and then they divide that into how many ounces are allegedly in Fort Knox, and they say that gives us a fair value of $6,000 an ounce. Okay, knock yourself out. Well, we don't know how much gold there is, and we don't know how much what the money supply is and all that kind of stuff. And so it's really impossible to do the calculation. 50,000 might be too high. 50,000 might be way too low. And if I ever get around to writing a book, that's what it's going to be about. But I just don't have the time. So if anyone wants to write that book for me, that'd be great.
Well, I'll get to work on that.
The simplest way to figure out what the fair price for gold is to let the market determine it. And the U.S. will never let that happen until the U.S. collapses and until it's incapable of preventing the market from finding true price discovery.
And that's definitely what we're waiting for, Dave. And that day's, I think we probably, all three of us agree, that day's coming. I mean, you can postpone economic Mother Nature for a while and keep the plate spinning, but at some point, the illusion shatters. And boy, it's going to be interesting to see because again, I don't know what's going to be. I'm not in this I'm not buying gold because one day it's going to be worth $50,000 an ounce and I'm going to sell it for a whole bunch of dollars.
You might not be selling it for dollars, Craig.
No, that's just it. And that's what I mean.
For one.
And that's what I mean. Or converting it into whatever the new global-based, current gold-based currency is. I have no idea what it's going to be. And Jim said something to that end in that interview with Greg Hunter last week. He said, this may be the rally that you never sell. And that's, I think, what he was driving at.
I agree with. I heard him say that, and I agree with that. I just wanted to make one little pre-editorial edit to something you had said, which was that you had made the comment that gold is being delivered at these prices, which gives the price legitimacy. And really, what it does is it gives the price the appearance of legitimacy. It's not a legitimate price.
No, that's a good point, Dave. And as you and I both follow the sham, the utter charade of delivery on the COMEX every month, whether it's in gold or silver, that's exactly right. There's an appearance of delivery. I'm sure there is some after a certain amount of time, some actual physical metal that is either delivered to somebody that had a contract for the COMEX. There might be some actual physical metal that is over time finally delivered to someone that bought it, acquired it through London. And so there is at least some connection to the everyday paper price. But again, the most of it is just kind of continued growth of leverage, continued multiple rehypothecations of existing ounces, whatever's left. And again, the longer that continues, the bigger the reset will be, the higher the ultimate, whatever that fair price is, the higher that price will be, the longer this current system continues.
And the more houses I'll be able to get with my gold. Or the more land.
Yeah, probably something like that. Or at least if anything, we talked about, kind of brushed upon it, I guess, earlier, the normalcy bias of the regular individual and how folks have just, brainwashed isn't the right term. I just think, because that applies, brainwashing means, you're like Patty Hearst. You knew what was good, and then you got brainwashed by whatever that group was, and they go robbing banks. So the idea that brainwashing means that that gold is right, but now you've been talked into saving in dollars instead. And so brainwashing isn't the right term. I just think people just don't know any better. All they've ever known is a dollar-based system that's been in place since the end of World War II. I mean, who's left alive walking the planet that even remembers what it was like now, before the global system was dollar based. I mean, you had to be alive and paying attention in 1930, so which means you were born in 1910, which means you're 105 at this point. So there isn't anybody, your neighbor, your friends, the people at church, none of those people can even contemplate a non-dollar based system because they don't even know that it's possible. And so they save, they work their fannies off, working 2 jobs. They got their spouses working, they're paying their taxes, they're trying to figure out how to put their kids through college and care for their folks and all this stuff. And all of that hard work is accumulated in dollars. And what does your friendly central banker do? On a daily basis, they are devaluing those dollars by printing more of them. And in a sense, devaluing your hard work.
Your labor.
Your labor. So folks just don't know better than to save in dollars when what they should be saving in is something that can't be devalued. Gold, silver, maybe other hard assets, whatever it is. But the idea that folks continue to accumulate and save and store up all their efforts and hard work and then hold it in dollars, which not only is the Fed devaluing, but, as China liquidates reserves, that frees up dollars, and all those dollars are coming home, further devaluing the ones that are currently there. I mean, this process is going to get ugly. All these people that are saving in dollars, their dollars are going to be massively devalued. And all of their hard work, all their life savings, all their net worth is devalued with it. They should be saving in gold, regardless of what's happened the last couple of years in the paper price. It is your only protection of your accumulated net worth and hard work. And now these falsely found, falsely discovered paper price levels, if you haven't gotten started yet, man, start now before it's too late.
Start now before it's too late. Well, Dave, is there anything else that you got?
No, I think we covered a lot of ground here. Really appreciate your time, Craig.
Oh, Dave, it's always a pleasure, man. And if I could give a shout out, I follow you on Twitter and I check your site every day. The stuff that you write, Dave, is a totally different category from what I write. I mean, the way you observe what's going on in the housing sector and the overall economy, and just pulling back the curtain on what a scam it all is, what a charade it all is just invaluable, the work you do, Dave. And Roy, the guests you bring on for these talks is invaluable too. So you guys keep up the great work, and anytime I can help out, you just let me know.
Well, certainly appreciate it, and appreciate all your time, and we'll do it again real soon.
Anytime.
All right, buddy. We'll talk to you later.
Thanks, Craig.
My pleasure.